Luminar Technologies filed for Chapter 11 bankruptcy protection in December 2025. 5 years earlier, its SPAC deal had valued the Lidar company at more than $3 billion. The promise was simple and powerful: laser sensors that could help automakers see the road clearly enough to make advanced driver assistance and self-driving features safer. Volvo became the customer that made the story feel real. Mercedes-Benz also announced a partnership. But by late 2025, Volvo had terminated a U.S. production contract that had been central to Luminar's plan. This is not a story about a fake product. Luminar built real Lidar technology. The failure was the business model around it: expensive automotive hardware, long production timelines, customer concentration, and a market that stopped rewarding promises before mass production could turn into durable revenue. The question is not whether Lidar can work. The question is how a company with marquee automaker relationships and public market hype ended up asking a bankruptcy court for protection. To answer that, we have to start with the vision that made Luminar feel inevitable. The pursuit of a machine that can see is decades old. Long before the DARPA grand challenges of the 2000s popularized the field, pioneers like Germany's Ernst Dickmanns were already achieving highway-speed autonomous driving in the 1980s. His work, alongside American efforts like Carnegie Mellon's NavLab program, established the foundational challenge: creating a sensor system that could interpret a dynamic world in real time. These early systems relied on complex computer vision and nascent sensor arrays, proving the concept, but also revealing its limitations. The problem was not a lack of ambition, but a lack of sufficiently powerful and reliable perception hardware. This was the specific engineering void that Luminar's founder set out to fill. Departing a prestigious university program, the founder's premise was built on a fundamental reimagining of Lidar technology. The company's innovation was a sensor operating at a different, more powerful wavelength of light. This approach promised to deliver what existing systems could not: unambiguous, long-range object detection far beyond the industry standard. Early demonstrations were compelling, showcasing a prototype that could see further and with higher resolution than any competitor. This technical credibility, combined with a clear and powerful narrative, attracted critical early funding and top-tier engineering talent. With a groundbreaking prototype and a powerful story, Luminar was positioned to capture the market. Its ascent was as rapid as it was spectacular. The company's arrival on the public market was not through a traditional IPO, but a merger with a special purpose acquisition company, or SPAC. This financial vehicle fast-tracked Luminar onto the public market and turned a pre-profit hardware company into a high-profile autonomy stock. The stock price surged on its debut, reflecting investor excitement around Lidar and advanced driver assistance systems. The capital markets had placed their bet, and it was a monumental one. This financial momentum was built upon a series of landmark partnership announcements. Commitments from established automakers like Volvo for series production and development deals with titans like Mercedes-Benz created an aura of inevitability. These were signals of genuine industrial ambition, even if the hard work of production still lay ahead. The media amplified this narrative, framing the technology as a leading solution for high-level autonomy and its founder as a visionary who had cracked part of the code. The company appeared to have a real lead. But behind the soaring valuation and celebratory headlines, a hidden fragility was growing. The promises made to Wall Street were about to collide with the punishing realities of the factory floor. The turning point was not a single broken sensor. It was the moment Luminar's customer story stopped looking inevitable. Volvo had been the centerpiece of the production narrative, the automaker that made Luminar feel less like a laboratory bet and more like a real automotive supplier. By late 2025, that relationship had become a public dispute. Luminar said Volvo had terminated a contract tied to its Lidar program. That matters because automotive hardware startups do not usually fail only from bad headlines. They fail when a small number of large customers, long qualification cycles, and high fixed costs leave very little room for a missed program. The deeper problem was the economics of becoming an automotive supplier. A Lidar company can show impressive technology years before it earns durable production revenue. But factories, tooling, validation, warranty expectations, and working capital all arrive before the cash flow is secure. Luminar had marquee names, but marquee names are not the same thing as a diversified, profitable order book. That was the strategic blind spot. The market had priced Luminar like a winner in autonomous driving perception. The business still had to survive the slow, expensive work of turning that promise into production-scale revenue. Once the Volvo pillar cracked, the story changed from breakthrough technology to balance sheet survival. The breaking point came when key partner Volvo terminated the contract that had anchored Luminar's production story. Luminar then filed for Chapter 11 bankruptcy protection on December 15, 2025. The company said the Volvo loss was part of the pressure that forced the filing. That made the fallout brutally clear. A company can have real technology, famous partners, and years of public market attention, yet still be fragile if its revenue future depends on a narrow set of automotive programs. Once one pillar fell, investors were no longer judging a moonshot. They were judging liquidity, obligations, and the chance of a restructuring. For employees, suppliers, and shareholders, the story moved from ambition to damage control. Luminar's bankruptcy plan gave it a path to keep operating while it reorganized, but it also reset the mythology around the company. The promise was no longer that one superior Lidar platform would define the future of autonomy. The new question was whether the business could survive long enough to turn its technology into a sustainable supplier model. Luminar's fall reveals a critical lesson that applies far beyond Lidar. What is the strategic blind spot that even smart founders and investors can miss? The lesson from Luminar's crisis is a brutal one, common to ambitious hardware ventures. It is the crossing of a second, more treacherous chasm, the production valley of death. While most startups focus on surviving the R&D valley to create a working prototype, the true test is the gap between that one perfect unit and a million profitable ones rolling off an assembly line. For deep tech hardware, technological superiority is not a guarantee of success. It is merely the ticket to a much harder game. The belief that the best tech wins is built on a fatal flaw. It ignores the brutal, hidden arithmetic of manufacturing complexity. Luminar's journey followed this classic failure pattern. A hype-fueled escalation based on a superior prototype led directly to a collapse triggered by missed production deadlines. Victory is not decided by breakthroughs. It is determined by unglamorous, grinding disciplines. Design for manufacturing, supply chain resilience, a relentless cost-down roadmap. Investors must ask not just if it works, but what the path to 1 million units looks like, and who on the team has scaled hardware before. While Luminar chased performance perfection, competitors offering good enough and manufacturable solutions exploited the opening. The market doesn't reward the best idea, it rewards the best executed one. This forces a critical question for the entire technology sector. Is the obsession with breakthrough performance blinding founders to the more fundamental challenge of simply being able to build it?